Hi everyone, let's go over my bullish and bearish Elliott Wave scenarios on Bitcoin, starting with the bullish scenario where we're looking for a 3-wave regular flat to the downside, where the common target for wave C is between the 1 and the 1.236, which is between 59.7k and 56.6k, taken from the high to the low of this wave A to the high of wave B with the trend-based fib extension tool. The extension target is the 1.618 at 51.6k. Now we do have some support in this area. First of all, we have the weekly gap here just below the wick at 59.2k. Closing daily candles below 59k does increase the probabilities to move towards the downside and fill the gap to 53k. However, we have an area of support in the middle of the gap, which is the 4-hour order block here, which is sitting between 56.6k and 57.6k, aligning nicely with the 1.236 as you can see. Now in the most bullish scenario, your wave C here is already finished with this ending diagonal structure. In this ending diagonal for wave C, we are looking at all the waves to be 3-wave structures, either in a simple, double, or potentially even a triple zigzag. In this scenario, price moved towards the downside and volume was declining nicely, which is something that you do want to see in a ending contracting diagonal. In this scenario, wave 5 is then finished and we are looking for price to move towards the upside, where an important level is the 67.3k area, as that would invalidate the bearish scenario that is coming up. Now locally, if this is the low, we want to count impulsive structures to the upside, which is either a wave 1, 2, 3, 4, 5, potentially a contracting diagonal or multiple 1-2s. If we then go to the 15-minute chart and we take a fib from the low to the high of this potential wave 1, then we are looking for a wave 2 retracement. An uncommon target for wave 2 is the 382 at 63.2k. The most common target area for a wave 2 is the 05 to the 786 area between 62.5k and 60.8k, and a level that you do not want to hit is the 886 at 60.2k. After wave 2, we are looking for price to move towards the upside in an impulsive wave 3. In the bearish scenario, which is still an ABC for a regular flat, so we are still in the bigger scenario of an ABC here, but in this next scenario, we are going to take the lows at least one more time. We are looking for this range here to be a wave 4. In the 1-hour chart, we are then looking for a finished 1, 2 and a wave 3, but all the price action that you see over here is corrective and part of this wave 4. And this wave 4 is then either a B and then a wave C running flat, or a wave W, X and then a wave Y. Within wave Y, we have a flat like this, 3-wave A, 3-wave B and then a 5-wave C to the upside. And then after that, we want to see price moving towards the downside. Now when we compare wave 4 with wave 2 in time, then we have to take a fib time from the low to the high of 2 to the low of wave 3, comparing wave 2 in time with wave 4 in time. And what you can see is that the current high over here is made before the 4 fib time, which is absolutely fine for a wave 4. As for this wave 4, we preferably don't like to see the 5 or the 6 fib time, because then wave 4 is becoming very long. And the 5 fib time is setting on Sunday, the 21st of April, 8 p.m. Central European time, and the 6 fib time is on Tuesday, the 23rd of April at 10 a.m. The invalidation for wave 4 is price moving towards the upside and hitting the 0.618 Fibonacci taken from the high of 2 to the low of wave 3. I put also an invalidation on top of this high, as if you take this high, probabilities are very high. You're going to take the 618 anyway, hit that level, invalidate wave 4. The bearish scenario on the 4-hour chart is that we're looking for a bigger impulse towards the downside. Now the probabilities are lower for this scenario because wave 2 hit the 886 taken from the high to the low of wave 1, which is very rare for a wave 2, common for a wave B or a wave X, and therefore the probabilities increase for this move to the downside to be either a wave C or a wave Y, which in turn increases the probabilities to move towards the upside at a later stage and continue the trend towards the upside. So if we then look at the probabilities of the different scenarios, then on the weekly time frame, the high time frame, the probabilities are higher to continue the trend towards the upside, as the probabilities here are lower for an impulse to the downside in a 1, 2, 3 compared to the flat structure on the 4-hour chart in an A, B, C, which is written over here. On the 15-minute, very locally, the probabilities at the moment are higher to look for price to move inside that target area, potentially first hitting the target box for resistance up here, 65.7k to 66.3k, but we have that target box just below price over here between 62.5k and 60.8k, the common target area, and the 382 uncommon 63.2k. As we have not yet hit this area, even for an impulsive and bullish scenario, you prefer to move towards the downside over here. Of course, if price does move down here, it doesn't mean we are going to see a wave 2. We have to observe the reaction and see some proof of support. Whatever that is for you, that can be a market structure change, bullish CVD divergences, candlestick patterns, maybe RSI, MACD, money flow indicator, whatever it is that gives you the confidence for price to move towards the upside. I hope that this video was helpful or valuable to you. Please check out the most recent educational video I've made about the best trading indicator you can use in my opinion, which is the CVD. And for now, thanks for watching and subscribing, and I'd like to see you at the next one. Bye bye.